Welcome. Thank you for joining us for this segment of our Business Solution Series. My name is Chris Fundora. I'm a certified financial planner and chartered retirement plan specialist with Traphagen Financial Group in Oradell, New Jersey. Today we're going to be talking about corporate retirement planning and specifically ways to reduce tax and increase our retirement savings. And so my objective here today is to provide you with information and directly applicable strategies for you to consider for your needs in your business. And that's whether we have no employees or we have 50 employees or 500 employees. There are different strategies for you to consider and definitely terminology for you to know. And when we typically talk to business owners, a lot of the questions or a lot of the misconceptions is that, well, isn't it very expensive and isn't it very complex to run these type of plans or strategies? And in reality, there is different ways that the government is trying to help us move in that direction. And so one of the things is that you actually get a $1,500 write-off for your startup costs. It's over 3 years, so your accountant or CPA can write off $500 a year for 3 years. And then in terms of complexity, that's why you have a team in place. It can go from very simple to more complex depending on what we want to accomplish. And those options and those features can be pretty substantial for you. So we'll go into detail on that. But one of the other things is that there really is a cost associated with not running a plan. And that tends to be that we're paying more in tax because we're not making that retirement deferral. And also, if you haven't heard it yet, you will. At the end of March, our governor of New Jersey, Phil Murphy, signed a law or a bill into law, A4134, also known as New Jersey Secure Choice Savings Program. It's a legislation that's going to require you, if you have 25 or more employees, to start having automatic payroll deductions, allowing your employees to make contributions to this state-operated, essentially, IRA. Now, if you have less than 25 employees, you're still going to have that option for this IRA account. But really what's happening here is that the government and where we are today, there is a movement towards having a retirement plan, offering a plan. And so you as a business owner have to make a decision of, am I going to be in a government-run plan where it's going to be to an IRA that, if that is the case, I'm not getting a deduction in New Jersey for my contribution? Or am I going to structure something for myself, right, that I can take different features and components and mold it to what I specifically need? So I think time is of the essence. This is going to go into effect within the next couple of years. So it's important to look at these options and consider for yourself what you would like to do. I want to start first with what most people are familiar with, which is a 401k. It tends to be what everyone refers to when they talk about corporate retirement planning. But essentially, this is our foundation, right? This is level one. And so in a 401k, you have the ability to make a contribution. You're not getting taxed right now in that contribution, and so that saves you funds in 2019 or 2020 whenever you make that contribution. Now, the 401k alone can be difficult because, yes, I can do $19,000 as an owner, or if I'm 50 or older, I can do $25,000. That's what the graph here on the left shows. But if I have employees, it gets a little complicated because my contributions can be impacted by theirs. There could be testing, a lot of different facets to it that do make it complex, but there are ways to streamline this, and we're going to go into that. But from a tax standpoint, if I'm making this $19,000 or $25,000 contribution, depending on my age, that's going to result in a tax reduction or tax savings of somewhere between $8,700 to $12,000, depending on what bracket we're in and how much we contribute. So it's pretty important that we consider this, especially if you're in the highest for the federal, which is 37%, or in New Jersey, 8.97 is one of the highest brackets here. So you could be getting taxed on your income at 45 up to 50%. And this is going to help you to save on some of that tax. Now, again, this is the foundation. There are other strategies that we're going to bolt on. But looking at the 401k, how do we answer this question of employee contributions and testing and all of these different facets? It's typically through what's called safe harbor. So if I have my 401k and I want to max out, but I don't want to get tested and I don't want to be impacted by my employees, I can do what's called a safe harbor contribution. Now, there's two options typically that you can implement, And so what one of them looks like is saying, okay, I'm going to offer a match. And so I'm going to give you dollar for dollar. This is to my employee. I'm going to give you dollar for dollar up to 3% of your comp. And I'm going to give you 50 cents on the dollar from 3 to 5% of your comp. So I'll go through an example of what that looks like. The other option is saying, regardless of what the employees contribute, I'm going to give them 3% a year, basically a retirement bonus. Okay, these things are write-offs for the business, which is nice, but we'll talk into why these different things could be beneficial. They both have their pros and cons, and it depends on your business specifically. But let's look at an example. If I have an employee who's making $50,000 and they put in 3% of their compensation, that's them the choice to defer 3% into the 401k. They just put $1,500 from their comp. Now you, if you're doing the matching or the non-elective, you're putting in 3%, which is $1,500. Now if you're doing the matching and the employee instead does 5%, they put in $2,500 of their comp. You contribute $2,000. It's not the full $2,500 because you said, again, I'm giving you dollar for dollar up to 3% and 50 cents on the dollar up to 5. So in effect, what that means is if you max out or you go up to 5%, I'm going to give you 4. In that example, again, here, 10%, they're putting in 5,000. We're still at the 2,000 marker. So by making that employer contribution, it's giving you the ability or the opportunity to max out your contribution, whether that's 19,000 or 25,000, which can be very powerful. A lot of the times people will say, well, maybe I don't have an employee. All right, I'm a 1099 business, I'm getting paid, or I'm Schedule C, and I don't have any employees. And so what tends to happen, and what we've seen pretty often, is that these individuals have been getting recommended to go into what's called a SEP IRA, SEP. And so personally, I do not like SEP IRAs. I think that they're moving towards being obsolete for better options like a solo 401k. So why do I think it's so much better? If you look here on this graph, the maximum contribution, if I'm under 50, in the SEP IRA, I can do 56,000. Same thing in the solo 401k, I can do 56,000, neutral. My maximum, now if I'm 50 or older, in the SEP IRA, it's still 56,000, but in the solo 401k, I can do what's called a catch-up and put an additional $6,000 in. That brings me up to $62,000. Again, there's more flexibility here. So if I have technically an employee contribution, right, I'm the owner and the employee, I can put anywhere from $0 to $19,000 or $25,000 every year. It's my choice. Then the other portion of your contribution is based on a calculation, tends to be around 20% of net earnings, a little less than that, but for simplicity, we're going to say it's around 20% of net earnings, and I'll save you on going through the calculation. But that's how you get that SEP number. It's the same calculation for the solo 401k. So I can do my employee contribution of $25,000, and I can also do my employer contribution into the solo, and that'll take me up to $62,000 with the catch-up. But the other thing is that there really is no difference in cost to set this up. So if I have a prototype plan, the difference between a solo and a SEP is nothing from cost. Now, what some people refer to is, well, once I have $250,000 in there, I have to file what's called a Form 5500. That is true. But if you set up a prototype plan, so what we do through our custodian, it gets automatically filed once they reach that 250 marker. There's no cost for that as well. So again, no real differential in terms of cost to establish these plans, but the benefits can be significantly different. The biggest thing, the reason why I like the solo 401k, particularly for us in New Jersey, is that if I contribute to a SEP IRA, I am getting a benefit in my federal return, which could be up to 37%, but New Jersey does not recognize my contribution to a SEP IRA. I get no benefit. They do, however, recognize a contribution to a 401k. So if I have a solo 401k, now my contribution is getting recognized in New Jersey, and that could be the $3,000 to $3,500 that I just saved in tax dollars. So it's very powerful, and all these things add up when it comes to taxes, as you know, and making those contributions for our retirement. So here's an example of this solo 401k versus a SEP. Again, this is if I have no employees, what I can do. And so here, a business owner is 52, has net earnings of $100,000. No employees, wants to make contributions to defer taxes and save for retirement. In the SEP IRA, based on the calculation that I mentioned earlier, they can do $18,587 as a contribution. They're going to save on the federal level, and let's say they're in the highest bracket, that's 37%. Then that means that they saved about $6,900 in tax. That's great. But if I do a solo 401k, I can actually contribute $43,587 to the plan, not only get the deduction federally at 37%, but also on New Jersey, and that could be 8.97%. So now I'm saving 45.97% tax rate on my contribution, and now that's $20,000. Significant difference between $6,900 and $20,000, and that's an increase of over 190% in tax deferral. It's very powerful, and it's that little change, that one change that just saved you significantly more tax in state. Now, there are other options that you can essentially enhance this. And let's say that I have a business and my spouse helps me, and I want to hire my spouse or employ them and pay them compensation for the work that they do. In this example, the owner pays their spouse, who's also age 52, pays them $25,000. All right, there's payroll taxes, you got to pay those, can't get around that. If I pay $25,000 after my payroll taxes, in the SEP IRA, I'd only be able to put in $6,250. But if I have a solo 401k, this is what I was talking about earlier, that employee contribution, you can actually defer the full $25,000 in this case. There's that flexibility, like I said, to do between 0 up to 25 if I'm 50 or older, or 0 to 19 if I'm younger than 50. So now what just happened is not only did I do 43,000, my spouse just did 25 on top of that. And so I'm close to 70,000 of contributions into a retirement account and saving on both the federal and New Jersey tax returns. There are more strategies to put into place, but I just want to lay this foundation for you to consider. If you have a SEP, definitely consider your other options. If you have a SEP with employees, without question, you have to consider other options because, one, it's inefficient, and two, you could actually have a liability. So definitely things to think about here. But let's go back to the, let's call it traditional approach where I have employees. So I set up my 401k, I'm making my contribution. What I can also do is have a profit sharing. So what happens here is I have the ability, right, like we said before, we're doing the safe harbor, we're giving the employees some sort of benefit, gives me the ability to put in $25,000, but now I can do a profit sharing. So profit sharing is based on a calculation. There's new comparability, there's age weighted, there's a lot of different ways to do this calculation to make it beneficial. But basically what happens is we get through to the end of the year, and let's just call it 2019, we get to the end of the year, now we're in 2020. We can review how the year went and decide how much we want to contribute. And we can contribute 0 or we can contribute much more than that, but it's your decision, and you do not have to make a contribution every year. Right, over time, we do have to make a contribution just to keep it active, but you don't have to do it every year. It's based on how your business does and how you feel about making that contribution. So it's discretionary. When it comes to the calculation, we'll go into an example. But here, if I'm making the full contribution on my 401k and getting the benefit from my profit sharing, I could be saving somewhere between $25,000 to $28,000 in tax in that calendar year, which is pretty powerful. So my funds are going into this retirement account or retirement plan. They're growing tax deferred. I didn't pay tax this year, which helped reduce my bracket. And then I'm hoping to get that compounding factor if my investment strategy is appropriate over time. Okay, this is the last component, or the last bolt-on. It's called a cash balance plan. So this has been overlooked. It's actually very poorly understood, in my opinion, but it's very powerful. So if I have a 401k, my profit sharing, but I want to make an additional contribution, and again, this is whether I have employees or not, I can do a cash balance plan. So in this example, or this chart here that we have, it gives you the ability to do 100 to possibly 300,000 of contributions to a retirement account and get that tax benefit as well. So if I have my own business and I have no employees, or I employed my spouse, and I have the ability, cash flow wise, to contribute up to 300,000, I just had a significant tax deferral this year, and I was able to save for retirement at the same time. I'm going to go through a specific example on that as well, but there are so many other things that this opens up. One of them is qualifying for the Section 199A deduction. It's also known as the QBI deduction, qualified business income. So in 2017, and Chris Chuddick went through this in his presentation, but in 2017, when the tax reform came through, now there's the ability, depending on your service or what you do for work, to qualify for this deduction. I'm going to go into detail on what that is, but it's another way for you to save on taxes each year. So this is the opportunity to really save or increase our contributions to a significant level, save on tax, build up retirement, and it really depends on what you want to accomplish in your specific business dynamics. But let's go into a little detail on what a cash balance plan is. So it could be very confusing. Some people refer to it as a pension, defined benefit plan. There are a lot of different titles, a lot of different terminology, but essentially, defined benefit plans are pensions, cash balance plans. All of those fall in category because we are setting a definition of a benefit. So what it is not is a traditional defined benefit plan or pension. So we normally think of police officers, firefighters, teachers, they're getting a pension and they're going to get that paid for life, right? Or we think about maybe if we know people or our parents worked for a company for 30 years, retired, and then that company paid them a pension. In reality, that doesn't happen anymore unless we work as police officer, firefighter in one of those industries that still carry a pension. But in the private sector, we're not getting a pension anymore, typically. And the reason being is that it's complex, it's expensive, it's difficult to manage, and you are guaranteeing someone that they are going to get X amount of dollars every year for their life. So what happened was cash balance plans came into effect, and they've gotten really popular over the last few years. But what it's doing is saying, I'm not promising you that I'm going to pay you X amount of dollars for. What I'm promising you is that we're going to make a contribution, and based on our contribution and a growth rate that we set, this is going to grow by about 5% a year. So when you get to retirement or you leave the company and you take those funds, now it's up to the employee. They can put it into an annuity, they can put it into a traditional IRA, but it's not on you to make sure that they have an income for the rest of their life. That is not a part of the cash balance plan. So it's basically a hybrid between that pension that we think of and a 401k. So what are those elements? In a pension, it obviously gives us the ability to make significant contributions, which we just saw. It only comes from employer contributions, so the employees are not participating. They get a benefit, but they don't participate. Benefits can be protected. So depending, we can have a federal insurance. It's the Pension Benefit Guaranty Corporation. Basically is in place. It's very inexpensive to have every year, but basically in place too that if something were to happen, at least a portion of these benefits would get paid out. There's one account typically. So as an employer, you could set up this one account. We do it for the clients that we work with. Contributions go in there, and then they control the investment strategy, which is important. Employer also provides the contribution level and rate of return that gets built into the plan documents. So like I said in that example, we're saying it's going to grow by 5% a year. That can be through performance in the market. It can be through contributions that we make. So if we're investing this and over time it is growing at 7%, obviously that's easier on the calculations. Or if we're just contributing a lot, that also kind of counts towards our bogey or our 5% target number for the employees. We can also set up vesting. So as an example, we could set up a 3-year vest where basically if we have employees, they have to work for 3 years. If they leave before that, their benefit reverts back to the company, back to you. So that's a nice feature. If you have some turnover, it kind of protects you in that way from just handing out money to people who are no longer employed. And so the 401k element is once someone's vested, let's say they're retired or you have this plan, you decide to retire, you close the plan, and you can move the funds into a traditional IRA or whatever you would like that keeps it deferred. No tax, no penalty. And so, again, you're not responsible for paying that monthly payment for life to any employees or yourself. The funds are pre-tax, so that gives you that tax deduction, that benefit. They're also protected from creditors under ERISA. And there's open investment options. 401ks have become significantly more open, which is beneficial. It used to be that you could only pick a couple mutual funds, and they tended to be very expensive. And now fees have been compressed over the years. More options have become available, and so you can make a lot of selections on what you'd like to do here. So the cash balance plan is really a powerful tool if it makes sense for you and your business, and that would be something to review. So let's look at an example. If I have all of these facets, including the cash balance plan, if I'm making this contribution, it's a dollar for dollar reduction in my taxable income. That's the benefit, and that's why my taxes go down. I'm not paying tax on this money right now that I put in. So if I put in $100,000, I'm paying tax on that money right now, and that could be $50,000 in tax that I just saved. So as an example, we were working with a client who has significant income and looking for ways to save on taxes, like us all, and build up retirement. So what we ended up doing was establishing solo 401k and the cash balance plan, and that gave them the ability to contribute over $200,000. Then they employed the spouse, paid the spouse who also made contributions, and so now they were well into the $200,000 of deferrals, saving tax on those funds. But the other part that was crucial is that we were able to qualify them for this 20% pass-through deduction. So I'm going to go into what that is right now, but basically they qualified because we got them under 415, and they got a $50,000 tax benefit for qualifying. In addition to that, because we reduced their income, they had a couple children, and so now we started getting the child tax credit. That was another $9,000 that we just saved. So we basically took down their tax from $190,000 on the federal level to $91,000. We just saved them $99,000 in tax on the federal. In New Jersey, we saved them another $9,500, and so overall, this individual saved over almost $110,000 in tax in 1 year, and also was able to contribute a significant amount to their retirement account to grow and build up that nest egg. So it's very beneficial, very critical to look at these things and make sure that they're done well. But this 20% pass-through deduction, again, Chris spoke about this in detail in his presentation, but if you have a flow-through entity or pass-through entity, S-Corp, sole proprietorship, partnership, you have the potential to exclude 20% of your qualified business income. Depends on what industry you're in and what you do. So some qualify no matter what. Others come into this range or this bracket where benefits can become limited or excluded. So let's say you're a doctor. If you're a doctor and you make over $415 as a married person, you're not qualifying for this and you're not getting the benefit. But if we run a strategy and go under that marker, now you qualify. If we're at $315 or less, you get the full benefit. And if we're at between $315 and $415 married, you still get a benefit. So it's reduced, but you still get that essentially write-off. It's really powerful. Again, we want to save taxes. We want to save for retirement. This is our goal and desire for structuring out these corporate retirement plans. And again, it does not matter if you have 0 employees, 10 employees, or 500 employees. Something can be structured to create benefit and tax savings. Now let's look at an example. So here, this was provided by our third-party administrator. And so in this example, we have 3 partners. And very typical, 3 partners, and they have 6 employees. When this gets calculated, just so you know, they only consider up to $275,000 of your compensation. This is 2018 numbers. And so in this example, 2 of the partners are making $275,000. Partner 3 is making $265,000. The employees are ranging from $30,000 to $75,000 in comp. Now, if you look to the right, the first is our 401k. And there, in that deferral contribution, The owners are maxing, so they're doing their 24/5. Again, this is 2018 numbers. They're doing 24/5 as a contribution to their own retirement accounts. And the employees are making their contributions, right? So let's say that those employees are doing 3% of their compensation by their own decision. They're putting those funds in. Then when it comes back to the company, in this example, the company is giving them the automatic 3%, right? Non-elective 3% safe harbor contribution. That includes the owners. So the owners are getting $82.50, $79.50, and then the employees are getting their respective contributions. It ends up being $9,270. So we get through those two components, and I'm at close to $100,000 that I just deferred for the owners, and the employees at $9,270 from the business. We get to the profit sharing now. All of these numbers affect the calculations for the other. So for sake of time, I'm not going to go through that, but if you look at this example, for the new comparability, that's one of the ways to do this calculation. In the profit sharing, the owners are able to get another $7,650 each, or another almost $23,000. They had to give some to the employees, and so that ended up being $6,000 that they paid out there. And this affects the cash balance plan. So now the employers put in the cash balance plan and were able to save into their respective accounts almost $400,000. They gave the employees about $6,000. So when we tie all these numbers out together, partner 1 and 2, who were the most highly compensated and made the same elections, they just deferred $213,000 into their retirement accounts. Right? That's direct tax savings on those funds and retirement benefits on those funds. Partner 3, less income, was able to still do almost $93,000 into their retirement account. What's the employee portion? The employer contributed $21,630 for the employees. So in percentage terms, 96% of the funds went to the 3 owners, 4% went through the 6 employees. So you were able to defer a significant amount of funds for yourself while still taking care of the employees and giving them that retirement benefit, the ability to contribute to a plan, and what I normally refer to as a retirement bonus. So very powerful in this regard. A more simple example, if we have one owner who has 2 employees, right, in that profit sharing column, you don't always have to do a 401k. If it doesn't make sense for you, you can just do a profit sharing and the cash balance. So that's something to consider as well and look at. In this example, the owner's doing that, and so in the profit sharing, they're putting in $55,000 for themselves. They're giving $3,500 to the employees. Again, that affects the cash balance plan calculations. And so in there, they're able to give themselves $110,000, and the employees getting about $1,400. So at the end of the day, every year, the owner has the ability to give themselves $165,000 if they want to, and they would give the employees about $5,000. That's 97% to the owner and 3% to the employees. So again, you're still giving the employees a benefit, motivating them, giving them that retirement bonus, and significantly reducing your taxes and increasing your retirement savings. Not only that, but there are so many other strategies that this opens up. Like I said before, you can do contributions for spouses, maybe do contributions for the children. That's another strategy. And then contributions to a Roth IRA. If you have a traditional IRA or a SEP IRA, this most likely is not going to be possible because there's an income limit, right? So if you're making over the limit, then the government does not allow you to contribute directly to a Roth IRA. However, in some of these strategies, the way that we can implement them actually gives us the ability to do a backdoor Roth contribution and actually get funds into a Roth IRA. Why is that so powerful? Because the funds that you put into a Roth IRA grow tax-free for life. So very beneficial strategy, especially combined with the other facets. So I hope this was helpful as an overview with some further insight into different ways that you can structure a retirement plan for yourself, your employees, your business. If you have any questions, please feel free to contact me. Again, my name is Chris Fundora, and you can reach me at chrisf@tfgllc.com or 201-345-5135. If you have any questions on HR or payroll, please reach out to Lisa at Balance Point, and she'll be able to direct you there as well. Thank you for attending this webinar. We hope that you found it very beneficial. And again, if you have any questions, please let us know. Take care and good luck.